Joining us now for our weekly strategy session is Asief Mohamed, Aeon Investment Management, Chief Investment Officer. Asief, you're in Cape Town. Welcome to the show. Here's a proposition for you. Investment strategy at the moment, given what's happened in the world in the last week or two and in South Africa, given mining developments in particular, get out of platinum and for the rest, wait and see.
I would agree with you, in terms of getting out of platinum, because platinum has been, the shares have been performing really badly over the last year or so. And it's largely driven, a couple of factors. The platinum price in dollars have been coming down, steadily been coming down. The other reason that the costs of getting platinum, especially underground mining, is very expensive, and that would include the traditional things that everybody's talking about. It's electricity, it's power prices, it includes labor, it includes falling grades, it includes just generally the cost inflation in that whole mining sector, and that includes it for gold companies in South Africa. It's just getting a lot more expensive to mine. However, one has to be very cautious in the sense that, you're probably going to get some terrible results coming out. But once, they curtail production significantly and it takes out this estimated surplus of about 500,000 ounces, you could find the platinum price possibly firming. So possibly on a 5-year view, I wouldn't say even a 3-year view, you've got to wait for these platinum share prices to come down a bit further, get an exposure on the back of probably economic growth picking up in about a year or 2 years' time, and then hopefully the platinum price going up. And possibly then you could make some good money out of platinum shares. Maybe
there's a psychological aspect here too, because we've taken platinum for granted so long as a growing commodity in terms of prices, in terms of the demand in global markets and so on. So it takes a bit of getting used to that platinum isn't in such demand, that it's at below gold in terms of price. But in the long term, this metal is going to be required. And there must be some value to be had, because what's happening really is that the market is working. The supply is too great, so they're closing down some operations until they need them again.
Yes, and that's the good thing about capitalism in a sense. It's what you call creative destruction. If there's too much supply and too little demand to take up that supply, prices come down, it then takes out these excess supply. The other thing that's not happening is that and this is where government is coming in at this point in time, where it's trying to help the industry, and they're having meetings now to try and bring down the costs of mining platinum in South Africa. And it's a bit late, I think, in the day that they've now come out. And I wouldn't just blame government, I would also blame corporate management of these platinum companies. Why only now are they doing this? Why have they not woken up and said, look here, these costs are just escalating at ridiculously high levels, and it's not going to make this industry sustainable. And I think here also the unions, and I don't really know whether the unions are going to make the bold step of cutting and agreeing to cuts, in fact, in salaries for unions. And I know it's a very difficult call, a very controversial call, but it's something that they have to look at. If you look at specifically at Greece, what they had to do now was cut the salaries of the state workers and the pensions of the Greek people in order to live within their means. And it's something that we've got to do here in South Africa. We've got to seriously look at that. People might say, already the wages are too low anyway. But how are you going to keep people in jobs, and how are you going to keep people employed?
Maybe
you'd rather want somebody unemployed than people in a job at a much lower salary or a lower salary that makes it more efficient and effective to take out whatever mineral it is in the ground in South Africa.
Well, we saw what happened to an uncompromising approach to wages in Britain to actually destroy the coal industry there. Perhaps platinum has had it too good for too long. And they should have taken the kind of view that Jacko Marie did with Standard Bank when he said the good times are the times that you need to cut your costs, not the bad times. But the other part of my proposition at the beginning was get out of platinum. That was the first part. Wait and see for the rest. Now, it's not, I suppose, a good excuse for a chief investment officer like yourself to say we can't do anything at the moment. There must be opportunities in this market if people are hanging back. There must be good companies that you can get into at reasonable value.
Oh, I agree with you, definitely there are. And if we just, just sit back a bit and say, okay, look at the banks, the big 4 banks in South Africa. They've had a very good run. They've outperformed the All-Share Index in the last couple of months by quite a margin. But if you look at the outlook for interest rates for the next 12 to 18 months to 2 years possibly, if you look at globally and in South Africa, interest rates, the Reserve Banks or the Federal Reserve have indicated quite clearly that they're going to keep interest rates low for the next 18 months at least. So the indication is there. What happens is that's good for banks, because if interest rates are low and it's not going to go up, consumers where they've borrowed and corporates where they've borrowed are then able to afford repayments, and the credit loss ratios should hopefully be a bit lower. And so banks in the low interest environment, where interest rates are flat for the next 12 to 18 months, they should perform. So if I would like to be exposed to the big four banks, and specifically Standard Bank, and you mentioned Jacko Murray earlier on, and also FirstRand. And I think they generally, it's one area of the market where you could say for the next 18 months you should be doing okay in it, but you should be cautious once there's a signal that interest rates are going to go up. Once you see that first signal of interest rates going up, you should be starting to lighten on banks and getting out of banks.
You mentioned FirstRand, and I think I saw a number the other day of 30% over the year that FirstRand has improved the share price. But mentioning banks, now we've had this news from Europe, Moody's downgrading 16 banks. Now, that probably doesn't tell us anything we don't know about the problems, but it does make life more difficult for the banks and for lending.
I agree with you, and the problem with Moody's and all these rating agencies, and in this case I would say that they've been about 6 or 7 years too late, because they should have done it before the global financial crisis. They should have seen it coming. The banks in the US specifically, not necessarily in Europe, the regulatory authorities there have put in a lot of safeguards. The banks have had to pull in, there's a lot of new laws. They've had to be a bit more prudent, although in one specific case that's not been proven to be the case. So the situation theoretically should be a lot better than it was 6 or 7 years ago. But now the Moody's is downgrading by about 2 or 3 notches. Some of the banks are just slightly above investment grade. Just at the lower level of the investment grade rating. So I just can't understand why they're coming out now. But nevertheless, they've done it. Scared the market. You've seen overnight what happened to the US market and to European markets. It's going to increase their cost of capital without a doubt. Borrowing, is going to be a bit more expensive. The problem with that, although it might be a bit more expensive, it's not going to be as expensive as one would expect, because there's a lot of cash floating around the world. Interest rates are very low. So I don't think it's going to increase the cost of borrowing as such. The other risk that you sit with the banks also is that at the moment they're borrowing, they're getting money from savers at very on a very short term basis. So the interest rates are very low, and they're lending out long, and that was also another risk which Moody's identified. So all in all, it's not going to be, it's from a US economic perspective, it's not going to be good, because it's going to increase borrowing. The banks won't be able to lend out as much as before, because they'll have to increase the cost of lending to corporates. But on the other hand, the corporates are cash flush globally, because they've not been investing, and in South Africa also they've been very cash flush. So it's a balance in terms of what's going to happen, but no, overall I think it's going to be negative for the US economy.
I have to ask you a question, which one hears a lot in the corporate world. People say, well, do we need these ratings agencies? Everyone listens to them in the sense of they govern the rate at which money is lent, and people use them as the guide. But their prime function of warning against bad risk, the fire detector, if you like, the smoke detector, the fire alarm, didn't go off in the mid-2000s. Should they have a role?
I think the only role that they have is keeping some wealthy individuals employed. So the unemployment is a bit less there, but nevertheless, as a whole, I think they have not served their purpose. But you can't also blame the rating agencies. You've also got to blame the institutional investors, because they aren't doing their homework themselves. They're relying on rating agencies to do the work for them. As an institutional investor, you can't do that. You actually have to do your own work. You have to make sure that you do the credit assessment properly. So you can't rely on these rating agencies. I've seen instances where the rating, and it's been well known that they've got it terribly badly wrong. There's just such a disincentive for them to put out a negative rating, because they get paid by the company that's issuing the negative rating. Yeah. Sorry, they're paid by the company that they need to rate. So there's an inherent conflict of interest in that. I would agree with you, but at the moment we don't really have a viable alternative. Maybe what should happen is that the company should pay significantly less to these rating agencies to be rated as such.
Well, there should be some central fund that supports them, so there isn't that conflict of interest. I've never really understood it. But thanks to Asief. That was Asief Mohamed, Chief Investment Officer at Aeon Investment Management.